Benjamin Fuchs arrived in Hong Kong in 1991 with $1,500 in his pocket, and he was backpacking. Look at him now. How did you do it, Benjamin?
Well, it was a lot of opportunities here, and I will say it was interesting to hear what was just being said, because I actually started in the futures and options market in Osaka in the early 90s, trading a lot of these products that I think we're going to hear about tonight.
Well, what drives you, first of all?
I think right now our main focus as one of Asia's larger, more successful multi-strategy funds is really broadening our footprint and thinking about how we can expand, not just for ourselves, but the broader Asian hedge fund universe. And we're very much of the belief that the more successful hedge funds and the more liquidity and people trading there are, the better it is for all the participants.
Benjamin, would you explain exactly what you do and the strategies you employ?
Sure. So we're a true multi-strategy firm. One of our largest business is trading volatility, which means futures and options, and we're active in all the liquid indices. Single stock volatility and FX is one of our key revenue generators. But we also run a very large credit business, and we're involved in everything from stressed restructuring situations to IG trading. And then the last business in our multi-strategy business is the convertible bond. So we run a big convertible bond arbitrage strategy as well.
And futures are right there front and center.
That's right. So we trade not only a huge amount of futures, but a lot of options on those futures, and that's integral to a lot of the strategies that we run.
I think that you should make clear that you are not directional, as most people would perhaps be in this room, and you look at the volatility. That's your métier.
That's right. So we spend a lot of our day looking at volatility surfaces, which is really just the collection of all the prices of, say, listed options and what's quoted in the OTC market, and are looking for mispricings and looking for distributions and providing liquidity to people that are trading in a directional way.
Benjamin, so how do you actually, when you look at the market, how do you see opportunities? What do you look for? What are the classic signs? Or, what flashes up for you?
So in the kind of futures and options space, in the volatility space, I would say we have very advanced systems and tools to identify what we think the surfaces should look like. And when we see distortions in those surfaces, either parts of the surface that trade too rich or too cheap, then we're buying or selling those parts of the surface.
So how would you characterize, let's say, equity markets at the moment in the emerging market space? In fact, let's not do even emerging markets, but what about Hong Kong itself? Because it seems like every bit of bad news has been priced into this market.
Yeah, it certainly does feel like there's a lot of bad news in the market. I would say from a volatility perspective, a lot of what's happened and a lot of the activity in the region has actually surprisingly been dampening volatility. And one really interesting feature, I think, for people in the room potentially where Asia is very different from, say, the U.S., is that in the U.S. we tend to see volatility spiking on the way down and really dying on the way up. But in Asia, I think we spent so many years in bear markets, people are like, oh, market's down another day, whatever. So we tend to see volatility actually trading off on the downside. And if we see moves to the upside, we actually see volatility picking up. And we actually think that creates a lot of opportunities because it creates a lot of distortion from how people normally think about the volatility and future and option surfaces.
So then I'm going to the whole thing about opportunities and how you seize them here as well. And just going to that point, how can you be predictive? What do you look at? Because you don't look at macro, you don't even look at micro. So what are you actually looking at? I mean, you do look at micro to some extent.
Sure, and we look at the macro. Well, we're actually not a predictive business. We're a reactive business. So our job in a big part of our business is providing liquidity to those who want to speculate on future events. And I think that is what's unique about our business. We're not a pure market-making firm, but we're really providing that back liquidity to market makers and people that want to speculate on big events. And maybe if I could just give an example, I think earlier this year, or maybe there was a lot of noise around North Korea, and a lot of people had different views. We start from a general macro view that we, having been in Asia obviously since the early 90s. North Korea is not a new story for us. It's not really, in our view, any more dangerous than it was 5 years ago, or probably will be in the next 5 years. But there was a huge amount of speculative activity that took place around the Trump meeting, the run-up to that, all the tweets going back and forth. And that's really what we can react to. So we see very big distortions because people are maybe worried about a big move or extra focused on something as an event. And that just causes a lot of distortion in the surfaces. And then we can trade around that and provide liquidity around that.
How have things changed in 10 years since the Lehman crisis?
That's a really good question. From a futures and options point of view, I would say hasn't changed that much. I think those futures and options exchanges have hundreds of years of experience and have seen, I think, much more dramatic experiences than Lehman. And so you saw those venues where we trade were pretty stable. And I think, if anything, people recognize the value of being on an exchange versus just me versus you, and I'll take your credit, and I'm sure it'll all be okay. I think that's the main change in the last 10 years. The big professional investors like ourselves, the banks that we deal with, we're trying to drive much more onto the exchanges as opposed to just trading on an OTC basis.
Well, we've seen what's happened to Hong Kong in the market here. Generally speaking, it's been down in Asia, up in the US. Now, how do you play that? Because it seems as though a trade war is being priced in to equities in China and Hong Kong, not in the US. It would seem that everything's smelling of roses currently. Well, not quite, but...
It's such a complex question. I obviously don't know the answer to it. We're not going to predict the answer to that, but I would say there are two really strong things. So one thing in the U.S., you have such a large amount of kind of automatic buying from the buybacks. You've had this big tax cut. Corporates get all this money. We know they're not giving it to their workers. They're going to buy back their stock. And so every day, those companies aren't saying, oh, I'm nervous about North Korea, or I'm nervous about a trade war. They're like, I've got X amount of cash. I'm buying back shares. That's how my stock options go in the money. And that's basically the behavior. So I think that, on the one hand, that kind of passive flow, and there's a lot of that in the U.S., is helping to support U.S. markets, would be one view. And then I would say the flip side in Asia, it's not clear to me that we're really reacting to trade war fears per se, as opposed to there has been a big crackdown on shadow banking in China. The regulators are actually doing a very good job and really squeezing a lot of the speculative liquidity. And that's fed its way into equity markets. And one of the ways for people to hedge is offshore, because there can be a lot of pressure on you if you're selling or shorting or hedging in China. As we all know, onshore, that could be construed in a counterproductive way, let's say, and you don't want to get that knock on your door. So I think a lot of that hedging and those activities have leaked into Hong Kong, and I'm not sure. I feel like that's more related to the crackdown on kind of the broader shadow banking sector than just fears on the trade war per se.
Yeah, absolutely. Volumes are really right down on the Shanghai market. And that is not good for you, is it?
Generally, we do better with larger volumes. That's for sure.
Okay, so where do we go from here? I know you're not that predictive, but that's what everybody really wants to know.
Exactly. We want to know that too.
Yeah, let's go to the future.
In terms of local markets here, it's hard to imagine more there's so much negativity that's out there. That's like nobody is bullish. And whenever we see a situation that's very extreme like that, we tend to think that the distribution is going to be distributed the opposite way. And so what I mean by that is we're not guaranteed to go up, but if you look at kind of the upside downside in a market like Hong Kong, I would lean on the balance of saying you have a much stronger chance of a surprise rally to the upside than a big shock to the downside, because the shock's kind of, as you said, been pretty thoroughly priced in.
You don't necessarily talk about specific stocks, but I was at the Stone conference, I think it was in June, and you came up with a play on Tencent. That's had a horrible year. It really has, and it was the key driver last year. It did fantastically. So explain what it was and how it's panned out for you.
Yeah, that's a great example of how we like to think about probability and distributions. And so what I talked about at Irasan is you had two things going on. You have this, I would say, global tech mania, if we will, and you have a company like Tencent, which is an amazing stock. It's the world's 7th largest market cap. But what do you need to do to become the sixth largest? Well, you got to beat Google. What do you need to be? If you look at what analysts were forecasting, they're basically calling for it to be the first $1 trillion stock. That would mean, going on top of Apple, and you're really in this elite group when you're in the top 7, let's say. So you really had a lot priced in, and what we're talking about is really for them to even hit numbers that the analysts were talking about. They're already on $40 billion of revenue. They need to, increase revenues by $20 billion. That's a huge number. That just doesn't happen that easily over the next 12 months. So we're saying, hey, distribution's shifted to the downside. Everyone knows the stock. It's up 10,000 times in the last 8 years. Everyone owns it. No one's saying anything negative about it. And reaching those things seems tricky. You've got a saturated game market. And at the same time, because people are so bullish, if you looked at all the volatility surfaces and the out-of-the-money puts were heavily offered, we're actually pricing in a very low probability of a downside distribution. So it was kind of this perfect setup where you had the distribution, and it's kind of hard to draw, but if you think of like the distribution of a stock being like that log normal was kind of shifted to the downside, and at the same time the puts were pricing as if the distribution was to the upside. So that's a situation that had a huge amount of edge. And I think there has been a lot of media coverage because the stock went down a lot after Irasan. But I think the key point there was we want to talk about the distribution was being mispriced, not that the stock had to go down. It happened to be that we got lucky and things went towards the distribution. But that was kind of a 30% probability in our mind versus maybe a 10% chance of a.
But you hedged that.
And so those puts you put on a hedge basis, as we talked about, and you could make money from a huge move to the upside or to the downside, but that trade was heavily weighted to benefit from a distribution to the downside.
How's it doing now?
Those puts? Well, it's actually, so this is an interesting thing about Hong Kong and Asia. Because people are still really bullish there, vol's been under a lot of pressure. So normally, if you see a sell-off like that, volatility would go up. Vol's been very constant. Trade's done pretty well so far. Still, we're talking about a 1-year trade, so we're about 4 or 5 months into it. So let's see how it turns out.
Mike wanted me to ask this question. Talking about ups and downs, what's had more ups and downs than cryptocurrencies? What about crypto futures? CME, of course, has a contract on those. Would you touch them with a barge pole?
I don't know if I'm strong enough to lift the barge pole, but I think getting them on a reliable venue is key for someone like us. Like the last thing we want is an exchange that goes bankrupt, or all the issues we're hearing about in the underlying currencies. I think for us to get really active in it, it would have to be less of a directional product and more of a volatility product, and maybe they're going to talk about rolling out options on those features, and that would be something that, of course, would be right in our bailiwick to trade.
What do you like at the moment, Benjamin?
So if we move away from futures and options and volatility, I would say in the vol space, I do think Tencent is still really cheap vol. You could get a big rally to the upside. There's still potential to move to the downside. I think we could continue to see a lot of volatility in the tech sector. I think the biggest opportunity in Asia right now is in the credit side. We've seen a lot of stress related to cracking down on the Chinese shadow banking sector. There are a lot of really good companies that are having to finance themselves offshore, 14, 15%. A lot of paper trading, 20, 25%. That's really a space where we tend to excel of getting in there and picking up, I'd say, the babies that have been thrown out with the bathwater. So I think that's a huge opportunity right now.
But Benjamin, as a retail investor, how would you approach it?
Bond? Oh, well, that bond market is easy for anybody to access and buy. Actually, on both the Tencent, there's a very liquid listed market in Hong Kong. You can trade those options, but also on bonds, you can easily trade through anywhere you have a brokerage account. So all those things are really accessible to anybody, not just to institutional investors.
Tell me, what has been the best trade you've ever done?
Best trade, I would say, in recent years would have been picking up a lot of distressed debt last cycle in 2014, 2015, when both people were expecting oil to go to zero and a lot of the commodity companies were really priced accordingly, and there was a lot of value to pick up there. And also when we had a lot of distress in Chinese high-yield real estate bond market, where everyone thought there was going to be this huge implosion in China and was pricing the end of the world. And we were able to pick up a lot of really attractive assets that, as we've seen since then, China didn't implode and it wasn't the end of the world. And those have been really huge home runs.
So the same adage applies, be greedy when people are fearful and be fearful when everybody's greedy.
I would say that is an excellent way to put it.
Well, I didn't say it, but I just did say it. What about the absolute worst trade you've ever done?
There are a lot of those tied at the bottom. I would say what comes to mind, we had both where we've made a lot of money in commodity bonds. We also got caught in the early part of the cycle with some companies that were too levered that ended up defaulting when oil initially collapsed. And we also had some exposure to shipping companies in Indonesia back in like 2010 when thinking that we were at the bottom of the cycle, and the recoveries on those things were just horrific. So pretty bad trades.
I'm just going to throw it to the floor for anybody to ask Benjamin a question. How liquid is the Hong Kong options market?
So that's a great question. I would say, and this is one of the challenge with futures and options, unlike a stock. I mean, you need we can have as much volume or as little volume as we have buyers and sellers for. So I'd say stock like Tencent, hugely liquid, single stock option. There's a ton of interest in it, and the volumes are really off the charts. H-share right now is not the most, I would say, liquid market, because there's a lot of people just have lost interest because, we've just kind of been in this long-term range. So it really comes and goes. But I would say generally H-share and the big theme stocks in Hong Kong, Ping An, Tencent, these type of things, have pretty good liquidity in the options.
Anybody else? Okay, well, I'll ask Benjamin this question, which is, are you still having fun?
Oh, I love this business. This is, every day I come in, super excited. There's something different to figure out. We have a large growing team, and there's, from people that are just new grads coming in and we're teaching them how to trade, people who've been doing it 20 or 30 years. And they do say that history repeats itself but never looks the same, and I think that's really true. And, we can see that in the credit sell-off that we're getting right now. In some ways it's similar to what we've seen in the past. In other ways it has very different characteristics. And it's really interesting puzzle to get in there and kind of figure out what's going to be the different piece and where you can get the juice.
Benjamin, if you had to give somebody a key bit of advice when they enter the market and they look at it, what would it be?
I would say really decide what your goal is when you're in the market. Like if you're a short-term trader, be a short-term trader. Don't all of a sudden come up with a big long-term value proposition, because that's probably not going to work. And if you're a long-term trader or investor, just be an investor, and you don't have to worry about what everyone says at the bar. Stick with your convictions. But on top of that, I would say the market is a tough taskmaster. So if you really think you're right and the market's wrong, I think we've all learned that can only last for so long. And so you want to have a balance between whatever you think should be happening and really understanding what is happening, because I think long-term being profitable in markets is about getting in sync with what the markets are doing, not what you think, not what you wish they were doing. I think that's... And
evolution of markets in the region. Tell me about that and where we are in the whole process.
I've been very fortunate to be trading Asian markets on the ground since 1992. And it's interesting because if you look at where technology was in the 90s, I mean, we didn't even have cell phones when I started. We were just getting email. It's hilarious. Excel was like a cutting edge tool type of thing. So if you think about going across all those decades, definitely markets have gotten a lot more efficient, but we've gotten a lot more liquidity. So it's really balanced off. So I would say the markets are way more efficient in Asia now. There's a lot more Asian capital. We're less dependent on capital from outside the region. But at the same time, we're able to make more money than ever because you can do things in so much bigger size. So I think having bigger, more liquid markets with maybe smaller edge that you can do larger is definitely more healthy and definitely more healthy for our business than, say, if you went back to the 90s when you could do very basic option strategy. Put call parity, for those who know what that is, was like a full-time strategy. And like now, the computers just keep everything in line. There's no chance to do something like that.
Everybody, please give it up for Benjamin Fuchs.
Thank you very much.